Goodwill is often the most valuable, yet least understood asset in a business sale. When a company sells for more than the sum of its tangible assets, that premium is goodwill, representing everything from customer loyalty to brand reputation. Goodwill is an intangible business asset that represents the difference between a company's purchase price and its fair market value. It encompasses elements like customer relationships, brand recognition, and market position that have been built over time. When a business changes hands, this goodwill transfers to the new owner through a goodwill sale contract. These contracts are particularly important because they formalize the transfer of something that cannot be physically touched, but often represents a significant portion of a business's value. Without proper documentation, the buyer risks losing what they've paid for, while the seller might face unexpected tax consequences. A critical distinction in goodwill transactions is between personal and corporate goodwill. Personal goodwill is tied directly to an individual seller's reputation, skills, or customer relationships. This is especially common in professional service businesses like medical practices or consulting firms. Corporate goodwill, on the other hand, belongs to the business entity itself and includes elements like the company brand, established procedures, or institutional client relationships. This distinction isn't merely academic. Personal goodwill is considered the individual property of the seller and may receive more favorable tax treatment, often qualifying for capital gains rates rather than ordinary income rates. This can result in substantial tax savings for the seller. When it comes to valuing goodwill, businesses typically use one of two methods. The residuum approach calculates goodwill as the difference between the fair market value of tangible assets and the total purchase price. The excess profits approach projects' future earnings above what similar businesses would typically generate. The latter method is more complex and less precise due to the inherent uncertainty in predicting future performance. A comprehensive goodwill sale contract should include several key components. First, it needs detailed definitions of what constitutes goodwill in the specific transaction. The contract should clearly allocate the purchase price among tangible assets, identifiable intangibles, and goodwill. Non-compete clauses are essential in protecting the transferred goodwill. Without such restrictions, a seller could theoretically sell their business goodwill, then open a competing business and recapture the customer relationships the buyer just purchased. Warranties and representations provide the buyer with assurance that the goodwill being purchased is genuine and transferable. The seller typically warrants that customer relationships are solid, that there are no pending issues that would damage the business reputation, and that financial representations are accurate. Tax considerations should be explicitly addressed in the contract. This includes clarifying how the Internal Revenue Service will treat the goodwill component, particularly when distinguishing personal goodwill to secure more favorable tax treatment. If personal goodwill forms a significant portion of the transaction, the contract may include transition assistance provisions. These require the seller to remain involved for a specified period to effectively transfer relationships and knowledge to the new owner. From a legal perspective, several issues require careful attention. The contract must ensure that the goodwill described can be legally assigned to the buyer. Some forms of goodwill, particularly client relationships, may not transfer automatically without explicit agreements. Courts may scrutinize goodwill transactions to ensure the valuation was made in good faith and reflects fair market value. This is particularly important in cases involving related parties or unusual circumstances. For businesses structured as C corporations, proper classification of personal goodwill can help avoid double taxation by allowing proceeds to be taxed at the shareholder level only, rather than at both the corporate and shareholder levels. Given these complexities, goodwill sale contracts should be detailed, customized, and aligned with both local business laws and federal tax codes. The stakes are simply too high to approach these transactions without proper legal and financial guidance. Properly structured goodwill sale contracts protect both buyers and sellers in business transactions. They ensure the buyer receives the full benefit of what they've purchased, while protecting the seller from future disputes and optimizing tax treatment. With intangible assets often representing the majority of a modern business's value, getting these agreements right is not just good business practice, it's essential.